Welcome to the Daily Update. This is Being Prepared Friday, June 3rd, where we'll look at the action in the market today and then see how things look for Monday, June 6th. And the follow-through buying that we were kind of hoping for just didn't happen on Friday. On a more positive note, we were down and down pretty heavy. We pretty much set the low at the open and then just danced along the line until the close. So there wasn't a lot of conviction behind the selling. The picture is still negative overall, but it still looks to be improving, and I'll show you that as I go through some of the charts. So let's go back and talk about what happened on Friday. Right at the open, we did gap lower, and we gapped below the daily pivot, which was at 41.43. Prices then went sideways right after the open. There was some selling not long into the day, where it took prices to below S1, and that's pretty much where we camped out and just about where we ended at 41.08. Prices spent the whole day just going a little bit above, a little bit below S1. At the close, we closed, as I said, at S1. We were down 1.63%. Volume was below average and declining. So as this continues on, we're really seeing volume tapering off. The technicals, as I said, they're still pretty negative, but hanging in there. That's kind of the stance I'm using right now. The markets are really worried about inflation, interest rates, growth concerns. That's what the stock market's worried about. But then there's all these other things too, like geopolitical concerns that I go through more of a list at the end, as well as earnings as they come out. So what are some comments that we can make? Elon Musk sent an email to Tesla executives saying that he has real concerns about the economy because he's so wealthy, because he's getting to be so famous. Whenever he talks, people react. And so the markets really didn't like that. The employment situation report came out, and that ended up being stronger than expected. And I'll go through some more of the details here in just a moment. Tech stocks were hit by negative news and downgrades. So when you take all of that together, it made for a negative open, and we just stayed negative as the day went on. Small caps were down, but less than the S&P 500. I'm really paying attention to small caps right now. They're looking more positive, and even when we have down days, they're holding up better than the S&P. And sometimes that can be a bit of a leading indicator for us. So I'm keeping an eye on that. The technicals, as I stated too, are holding up, and I think you'll see that as I go through the different charts. Oil is up to just under 119. It actually got above 119 and then fell back slightly. Gas is still going up and up and up. Fear is high, but not necessarily extreme. I took out the statement that says the S&P is in correction territory. We've been saying that over and over and over for the whole year. We know that. And plus, we have a chart that shows us that. The economic reports that came out, we had non-farm payrolls, and they increased by 390,000. That was a lot higher than expected. They expected 325,000. The unemployment rate remained at 3.6. They expected it to go down to 3.5. But I will tell you, a lot of the market really doesn't pay attention to that. It makes for a good headline, but that number is manipulated so much that it's really not noticed. They look deeper into the report, such as the average hourly earnings. That's usually a big one. They were up 0.3%, but they expected them to be up 4%. The market could have switched that around and taken that as good news, but didn't. The average work week was 34.6 hours. That was as expected. The labor force participation rate increased to 62.3 from 62.2. That could be seen as slightly inflationary, even though it's only 0.1%. The employment population ratio increased to 60.1 from 60. So underneath the surface, tiny bit stronger than expected. The headline number of the jobs, that was stronger than expected. But the earnings, which is more inflationary, that actually ticked down a bit. The ISM, that's the other important report that came out on Friday. It decreased to 55.9. They expected it to be at 56.6. So that was quite a decrease. Last time we had this report, it was at 57.1. That is suggesting an economic slowdown in the non-manufacturing sectors of the economy. The IHS Market Services PMI, which is not a real big influencer, it dropped to 53.4 for the final reading after it gave us a reading of 53.5 in the preliminary reading. Looking at our trend condition, we're still negative overall, but it is weakening and starting to cross positive, and I'll have a chart to show you that. I've switched the bias back to mixed because we had a pretty solid down day after having been going up, and I've switched our momentum back to mixed just because of the strong down day. Now, it was strong from a percentage standpoint, but it didn't do an awful lot to change our charts. So let's go back, talk about the day's session. First, looking at sentiment, we are at 27. Yesterday, we were at 26. We ticked up to 27. And this just shows how we finally came up out of that extreme negative reading, but we could go back down into it if we see some serious declines. The VIX ticked up slightly, not as much as what you would expect on a 1.6% decline, but it did go up. And we actually closed near the bottom of the bar on the bar chart. The VIX of the VIX is still showing a slowdown with the bars, and on a closing basis, it continues to drop. Ulster Index is pretty much back to neutral. It's right on top of the moving average, and here's the longer-term chart. Equity put-call ratio advanced, which could be expected on a down day. More people are hedging or getting into puts. And it increased slightly with our 5-period moving average. We had another reading. It seemed like I just came out with this, and now it updated again. With the Ridex bear-bull ratio, it had spiked to up over 21. Well, we fell down to 19. It's still extreme, so it's showing that people are pretty negative still, but it declined slightly. Here's a chart from IsabelNet, and this is a sell-side indicator that was created by Bank of America. I wish I could get my hands on this, but it's proprietary how they calculate this. And we have a red band on the top and a green band on the bottom. And then the middle is just this indicator that it measures. When we get above the red line, that's extreme bullishness. That means people are too happy. And that's bearish for stocks. And if you look at when this really spiked up, that was during the dot-com boom. And then after that was the dot-com bust. So we really ended up falling down. We declined a lot going through the financial crisis, but it never got to an extreme point. When we really fell was back into 2012, 2013, when the markets hit some difficult times. And then we came back up. Didn't show all that much during the COVID plunge. It declined, but never went extreme. We had been getting back up to the red line, but for 2022, we've been coming down. So overall, they're giving this a neutral rating. Normally, I wouldn't show this, but this is not something that they post very often, so I have to kind of take advantage of it when it's available. Another thing is the Fed balance sheet with the quantitative tightening, that's QT. Quantitative easing is QE. I know they sound alike and they can easily get confused. The blue line is what we see right now. This is the Fed balance sheet right here. What they've said they're going to do is they're going to taper. They're going to start getting rid of the bonds and the mortgage-backed securities and the corporate bonds that they were buying to help stimulate the economy. That's what they said they're going to do. Now, based on Deutsche Bank, they suggest that in October or November or late 2023, we're going to enter a recession at that point. And then down here in 2025, the reserves reach the minimum needed. Quantitative tightening ends up concluding. That's just what they're predicting on this chart. Another chart just shows retail investors. Those are people that buy through a broker. They're favorites. That's the blue line here. And this is the Amazons and the Googles and the Apples and all the biggies that everybody really likes. They were really going up going into the lockdowns, but we hit 2022 and they've really been declining in comparison to the overall S&P 500. So yeah, they did outperform there for a while, but now they're getting back to the point where they're still outperforming, but not as much as they were before. Looking at some inflation things. Here's the CRB. It was up slightly on Friday, but is still in an overall uptrend on the daily chart, showing that inflation is still a real problem. Gas, man, it's up to $4.25 now. Heating oil, not up to where it was before, but is still going up. It's at $4.28. Here's the chart that I first showed yesterday, showing the monthly chart. So I'll probably not show this as often. I just wanted to include this because it's a newer chart. This is a monthly chart of the CRB index on the top. Then we take the inflation index and the deflation index. We do a monthly ratio, and it shows that we're kind of getting back to more of a neutral stance. We're back down to the moving average. This doesn't suggest that inflation or deflation are really winning overall. You could make a case that inflation is winning out because we're above the moving average. Another chart from IsabelNet shows inflation is a monetary phenomenon. Well, yeah, it has to do with money. But the black line here is a thing called M2. We used to have a thing called M3, but they stopped doing that because it was giving us a lot of information that we found useful. And back in about 2005, they said, well, we're not going to let you see that stuff anymore. So they've had to kind of recreate their own. M2 is kind of the broadest measure of money in the U.S. economy. And this is advanced by 9 months. I don't do a lot of this personally. That's why I look at them on these other charts, because to figure out how far to advance it and everything is all crazy. There are a lot of people that I follow that do this. They'll try to find comparisons either in the same market or in different markets using different time periods and then overlap them with each other and try to find the similarities between the two. But when we shift the M2 money supply ahead 9 months, it really went up as QE and all the stimulus and everything was going into the economy. Well, now it's been really coming down. We compare that to the CPI, the Consumer Price Index, which has been really going up too. This is where we're getting our inflation rate from. Well, if you shift it ahead with the M2, that really declined. Is that going to happen with CPI? If this ends up happening, that could help suggest that inflation is lessening. Interest rates may not need to be raised. They can focus more on repairing the rest of the economy. But this is just a hypothesis right now. Looking at our sectors, discretionary, which did really well on Thursday, did really the worst on Friday, down 2.92%. Tech, communication, the usual weaker sectors really underperformed on Friday. We had one sector that was up, was energy. It was the one sector down on Thursday. It was the one sector up on Friday, and it was up 1.32%. And here's our chart, just showing energy doing very well, followed by utilities. This has been the place to be for 2022. We're way over on the right-hand side. We have discretionary in last place. And even though it's been improving, it's still down the most of any sector. Because we're looking at this staples spike later in the video, I wanted to include a chart that just shows the staples sector all by itself. And it's been in a solid uptrend. It started back in 2020, continued through 2021, has really spiked up in 2022, but lately we're seeing some weakness that is developing. But overall, we're still in an uptrend because the 50 is above the 200. Technical alerts. This will be a surprise. There were no alerts. I went to the spot where I usually get them, and it just said no alerts were generated today. So let's go in and look at the intraday chart where we gapped lower below the pivot. We built a bit of a base, and it looked like, okay, are we going to take off now? Nope. We ended up dropping down to S1, even fell slightly below S1, and we danced along that. We tried to go up, but that didn't work, so we came back down to S1 and then just pretty much finished out the day. So all of the move was set within the first hour to hour and a half of the trading session. Looking at our daily chart, we're still above the pivot, so that's positive. We're still above the long-term support, that's positive. And I mentioned this as overhead support. That was not right in yesterday's video. This is overhead resistance if we go above this line. This line was established as support, but when we fall through that, now it becomes resistance if we start going back up. Looking at the bottom, you can see where volume really trailed off. We're well below average and declining. We're down 14.34% from the all-time high. Nothing has changed here. This is just a broken record for those things that continue to be in uptrends. Same thing with the negative side. I just rattle off the list here because those things that were negative continue to be negative, even though some of them are showing some improvement. So let's go and look at the trend where we are declining with the ADX. The red line is coming down. It's kind of hard to see the green line right here, so it's not real evident what's happening. We look to be crossing positive, but these lines are still so close to each other that the ADX itself is dropping, and we're at 20.51 right now. If we drop below 20, that is the definition on a static number basis that we are now in a trendless environment. The Arun hasn't changed. Our oscillator has been flat. Although we're seeing a decrease in selling pressure, we're also seeing a decrease in buying power. Looking at breadth, we're still working off of this positive divergence. That's still in play. But we saw a decline in the advanced decline line based on price and volume. The advanced decline ratio is still above 0, even though it did decline. New highs, new lows continue to go up. You can see right here, we had more new highs than new lows overall. So that's a little bit deeper look, showing that even though we were down, there were more stocks making new highs than there were new lows. And our 5-period moving average is going up, and our 10-period moving average continues to advance. Accumulation distribution, yeah, it was weaker on a down day, but we're still above a rising moving average. The 10-day average of the highs and lows, we're getting more up to a neutral stance right now, where we had been extreme negative, but we did go above 50, so that could be considered positive as well. Some short-term charts were still above the 20-period moving averages. Rate of change is still extreme positive when we look at the 10-day rate of change. The other rate of change charts that we look at are more normal. They're not showing an extreme reading. Our rainbow, we're still trying to get up through the underside of the rainbow, but we sure didn't do that on Friday. McClellan oscillator, after being extreme positive, fell down, came back up to positive. Now it's still positive, even though it declined, and we're above 0. The force index declined as well, but is still above 0. Stochc RSI coming down off of an extreme positive reading, and not quite off of that reading with the Williams percent R. 20-period moving average, not extreme right now. Did see a decline on the 50 and the 200. Stochastics, these are still pegged pretty positive in the short term, rolling over a bit in the intermediate term, still showing improvement in the long term. Looking at some intermediate charts, all of our momentum oscillators continue to be positive. The vortex, it's still positive, but we saw a decrease in buying and an increase in selling. Swinland trading oscillator. Maybe this didn't fake us out after all. It was going down yesterday, and then we ended up having a down day. Well, it's continuing to go down, so maybe it's acting as a bit of a leading indicator currently. BPI still put in a little tick higher. So that's one of the reasons why I say the technicals are holding up. The BPI continues, even though it's minuscule, it's not declining, it's actually advancing slightly. PMO is still positive pretty much across the board. We saw a decrease in the percent of the PMOs that are rising from extreme positive. We're rolling over a bit with the buy signals. We're still advancing with those that are above 0. Summation index based on price, it curled over a little bit, but it's still above 0 and it's still advanced. Also with volume. CCI 14 coming off an extreme positive reading. We're just ticking down slightly with the CCI 20. Ease of movement did show a bit of a decline, but we're still above 0 overall. Volume intensity with the decrease in volume, that's why we're seeing this line going down. Chaikin oscillator showed some weakness. Chaikin money flow is more flat right now. The money flow index, after having a pretty nice run up, did decline, but we're still above 50. Ultimate oscillator also declined after having a nice run up and above 50. TTM squeeze is still showing that we're improving, and longer term, it's looking a little bit more positive. Our different charts, Heiken Ashi has a bit of a doji candle right now. The Kegi still remains positive, as does the Renko, and our 3-line break is still holding up. So our trading systems, the Elder has switched back to neutral with the S&P and is neutral with the SPY. The SAR continues to be positive. Our go-no-go system is more in neutral. It's the lighter purple color. Long-term charts, we're well below the 200-day moving average and have been for a long time. Saw a bit of a decline in our 50-period study, 150 and 200. Special case, still trying to turn up, but has a long way to go to get to the red line. Here's the Fib retracement, where yesterday it looked like we broke through this Fibonacci level. Well, we now fell back below that. Here's another Fib chart, just going back to a significant low that was set back in 2020, as well as the low set after the COVID plunge. And we have some pretty significant overhead resistance. Here's a weekly chart just showing how a few weeks back we bounced up off the 38.2% retracement. And even though we had a down bar for the week, we're still well above that support level. Looking at the broad market, we're neutral with the diamonds as well as with the Qs. The Vixen also continues to decline with the bar chart, but we had a little bit of a tick up on a closing basis, but not as much as you would expect on a pretty hefty down day. Here's the small cap index. We were able to get slightly above the 50-period moving average. Well, it started at that point and then went down below that. Here's another new chart that I'm including. This is the small caps ratio against the S&P 500. So when this is going down, that means small caps are underperforming. When this is going up, that means small caps are outperforming, but we're starting to see a break above these moving averages. That's what we're looking for in the spike. We want this to be going up and even get back into a positive uptrend for that spike to remain valid. This is another chart from IsabelNet put out by JP Morgan, and it's just showing that small cap valuations are at all-time relative lows. We're way back down here to this line, and that's a relative line. It means that small caps are very undervalued right now according to this chart, and that could give them some thrust, which could feed over into the S&P 500. Looking at the broad market, the dollar bounced up about 0.33%. It's still showing some real recent weakness, but the overall uptrend is still intact. This is what we're watching for. We spiked up back in May. We're back down around this red line. We're seeing, can we go back up, or are we going to see the dollar come back down? If the dollar continues to decrease, that could be a positive backdrop for stocks. This compares the S&P 500 with the dollar index, where we are moving in opposite directions, but we ticked up slightly. Oil is at 118.87 and just at astronomical levels. The gold futures are back above their 200-day moving average here with the ETF. Even though we were down over 1%, we still are above this moving average. And here's the longer term look. And I said it wrong. I should have said a series of higher lows. That can be a real tongue twister when you're going through these charts. Silver was also down 1.75% after a recent death cross, and we are below the moving averages. Here's the long-term chart, and this is setting a series of lower lows. Comparing the S&P with oil, having a pretty strong correlation. So if oil's going up, the market's going up, but not on Friday. That's why we ticked back down. Oil was up, but stocks were down. Looking at bonds, seeing more of a decrease based on price. Maybe they've worn off this extreme oversold condition, at least on a short-term basis, before it's getting set to go lower. The total bond ETF was also down slightly after coming up to the 50-period moving average, and it's been bouncing back from that. High leverage loans were down slightly on Friday. We just want to keep an eye on these. Those are pretty risky. We did see an advance pretty much across the board with the yields, although the 10 and the 5 continue to have a very serious relationship. And on the 3-month, we really spiked up as well. Because this is a weekly chart, I just wanted to show some international rates where the U.S. has the highest rate, and that increased over the last week, as did rates in the U.K. and Germany, but Japan is still pretty much flat and very, very low. That's because of the situation that's going on in Japan, which may bleed over into the U.S. economy. But it doesn't seem to be making a huge impact, at least yet. And that's why I'm not talking about it more than I have. Here's an intermarket analysis chart showing how well oil has done since December 31st. Number 2 would be the dollar. Number 3 is gold is still up slightly. Stocks have been down heavy, as have the price of bonds. Our possible positive scenarios, the Copic curve, still giving us a signal. The spike, we still don't know if that spike has really become valid. And again, I want to point out that when we do see this spike, that's usually a short-term move. We're not seeing a major market bottom, usually after we see this spike. Mass index also generating a recent signal. Pring bottom fisher. This does pick market lows, and it does look valid still, even with the down day. Here's the small caps, and I'm trying to keep an eye on this because we saw a real tiny spike up. Are we going to see that again? If we see follow-through buying in the small caps, that could really help the S&P. This is the most viable scenario right now with the staple spike. We've really been coming down. We put in what could be a spike. Now we're just waiting for price to confirm that by really moving higher. So what's our outlook for Monday? The technicals are holding up after having a pretty short-term overbought condition after the big up day we saw on Thursday. Sentiment is still quite negative. We have the battle back and forth between growth and value. It looked like value won out on Friday. Economic reports, there aren't any coming out on Monday. Geopolitical events, the same. Russia, Ukraine, and any one of these could switch positive or negative or kind of stay in the background, which is what most of them have been doing lately. The supply chain issues, inflation and interest rates are what the market is really fixated on right now. Oil just keeps going up. Earnings did not turn out to be a very good day on Friday. Fed speak, they seem to be walking back their scenario that they might lessen or slow down their rate increases this fall, which is now looking like it's becoming more of their policy. And then the longer term situation in Japan. So our scenarios, we're still negative overall because of all the things I mentioned. We still want to be aware. If we see some more strength from here, we might see some selling into that strength. The technicals they're still negative, but they're looking better. What could help us to go up from here? The technicals are looking better. Sentiment is still pretty extreme. Possible positive scenarios that I went through earlier, the Copic curve and the Pring and the mass index have all triggered signals. The staple spike looks like it's coming through, but we're not seeing that in price. We're still having a hard time with the 2-year yields, and we're keeping an eye on the small caps. The technicals are showing some improvement. We have different pivot levels, the shorter term moving averages, fib retracements, and previous highs or lows or pivot levels may provide either support or resistance. We're not in a sideways trend, but we're getting close. If we fall a little bit more with the ADX, we might end up dropping below 20. But for right now, we're still defaulting to the negative trend because the green line hasn't really broken out. So our conclusion then is the S&P could be turning positive, short-term positive, but we saw the weakness on Friday. Intermediate term negative, but could be turning positive. Long term, we are still negative. So thank you. Have a really, really good weekend. I will prepare the weekly video and the intermarket analysis video to post over the weekend. And yes, I'm running this out a little bit to drag out the time in the video to avoid the end cards from popping up while I'm trying to show more relevant information.